February 2026 National Real Estate Trends Update. I'm Nick Elder with Ironton Capital, and as usual, I am joined here by the man himself. There might be some forward-looking statements involved. Of course, this is not an offering of an investment opportunity.
Good buddy Lon Welsh, who we all know and love, put together a lot of new information. We try to keep these fresh, and I'm excited for what we've got to share with you guys this evening. So let's get started talking about consumer confidence, because this is something that I think is really, really critical right now. Consumer sentiment has improved over the past 5 months, and really nice thing we're seeing, consumers are expecting less inflation, which seems to be driving the overall result. But I do want to bring your attention to this chart on the far left. If you go back and look at 2020, consumer confidence was at an all-time high. And you see it where it was ranked at just under 100 there on the left slide in 2020. And then there was this huge decline. And I think we all remember in early 2020, there was a pandemic and everybody, was in a panic. The world was shutting down. Nobody knows what's going to happen. Oil prices are falling off a cliff. We can't show homes. We can't get mortgages. And then suddenly things begin to improve and we see confidence really ramp back up through 21. And then 22, you see things again really go far, far down. And what you see, that is when interest rates really started increasing. Then through 2024, consumer confidence begins to pick back up. Now down here in 2026, late in 2025, I think it was October of 25, we had the worst consumer confidence rating on record. We have improved over the past 5 months. And Nick, when consumer confidence is low, people don't feel like they want to go out and buy a new car or a new washing machine or a new house, which is what we always talk about here. So I'm seeing this pick back up in the conversations that I'm having with people, but I do think we still have a long ways to go before the overall sentiment in the economy is where people say, hey, I feel like things are really humming along and doing really well. So do you agree with that? Do you see that people feel like we've kind of turned a corner, but we're not back to going like gangbusters? Do you see that, Nick?
Yeah, I would agree. And I think consumer sentiment and confidence is not talked about enough. We talk about it in one slide here, but you look at like anything investing, and it's so largely driven by human psychology and behavior, whether that's in the stock market, in the real estate market. And when you look at like a lot of the crashes that have happened in the past, I'm not saying there's one coming. Nobody knows if one's coming or not. But the commonality and denominator there is that consumers had zero confidence in the market and in the economy. And so I think that's very telling. I think what we really need, interest rates can come down a little bit, right? But if consumers are still not confident, it's not going to drive them to make the behavior to maybe invest in the market or go refinance on their house or go buy another house, right? If they're still encumbered by affordability problems. So I think we need to really pay attention how the consumer sentiment shifts. If things pick up, which I'm starting to see a little bit of that, but if things pick up and consumers are getting more and more confident, I think that's when we're really going to see a turn of things in the coming years.
Yeah, I completely agree with that. Now, this one is a new slide that we've got in here. The cumulative post-pandemic price shock and increasingly negative media coverage and a higher share of Democratic respondents explain just over half of that 2025 sentiment gap, but a substantial portion remains unexplained. So if we go back and we look at consumer confidence, this is the things that why are people feeling so negative? Well, pretty obvious, sticker shock since the pandemic. Prices have gone up. A shift to an online economy. That has led people to be uncertain about their jobs. Negative media bias. If everything you hear is negative, you feel negative. Rising share of Democratic respondents that just feel negative about the political environment. But then that big purple bar, there's an unexplained portion why some people just feel like things are bad. You tie all of these together and you get that big blue bar on the far right that folks just don't feel great right now. And again, back to what we said a moment ago, if a lot of people aren't feeling great, they're probably not buying cars. They're probably not buying washing machines. They're certainly not buying houses. But I do think we're shifting. We're seeing the spring selling season really get started right now. So I think this is, again, shifting back in a more positive direction. a big cause is inflation. So a lot of people have been worried about inflation. You go back and look in the COVID years, 20, 21, 22, inflation was upwards of 5% in some of those years. We've gotten now down to where we're below 3%, still above the Federal Reserve target rate of 2%, but certainly not that runaway inflation that we had for a number of years. And this has allowed the Federal Reserve to begin decreasing some of the short-term interest rates. We've seen the prime rate come down. We've seen the overnight Fed funds rate improve, and we've seen improvements in mortgage rates. Unemployment is really steady and really low. And consumer confidence shows that people expect higher unemployment in the future. And part of the confidence question, I can find a job if needed. A lot of people don't feel really great about that question. So consumer confidence, again, comes back to, hey, if I were to lose my job, can I get another one? I had a really interesting conversation with one of my good friends and clients, and he's an attorney and his wife is an attorney. And they said they're actually really worried about their jobs being replaced by AI. And that has led them to shift some of their investments. They traditionally would buy 1 to 2 investment properties every year. And they've decided for this year and next, they're not going to buy any investment properties because they want to keep more of their net worth in cash in the event that they're laid off, right? So artificial intelligence, that can be a great thing, can also lead to some of that lower consumer confidence, which I think if we go back to this slide here, might be a portion of that purple bar that people are worried that their jobs are going to be replaced. They're not exactly sure how, but it could happen if artificial intelligence gets smart enough to replace their positions. So having that confidence that, yeah, if I lose my job, I can go get another one. A lot of people are saying no to that question right now. Do you see that, Nick? Do you hear any of that? Folks worried about becoming unemployed?
Yeah, and you see people in the tech industry, right? There's a lot of entry level roles within big tech that can be replaced by AI. And I won't go down the AI road, but the $200,000+ a year software engineer, and there's dozens of them working at a company. You might just need 1 or 2 at a company now because AI can replace a lot of those functions. I mean, that could be a job that's not entirely obsolete, but a lot of folks that are right on that border. So I think we're going to see it a lot more in tech too. Again, I'm not an expert, but I do believe that a lot of people are uncertain. They don't know what the next couple of years look like or what the future looks like. So to your point, they don't want to go tied up in an illiquid asset where they can only access the cash if they sell it, right? They want to hoard the cash. They want to keep it. They want to position themselves and prevent any downside.
Yeah, that's exactly right.
Yeah.
And then this one goes right along with that. Job growth is slowing down. So job growth looks like this seesaw pattern. That is, of course, some seasonality to when folks get hired and laid off. But you see that overall growth is really on a downward trend over the last 4 years. Now, it has not gone negative. We are not losing jobs in the economy, but we're not adding as many as we did 3, 4, 5 years ago. And that, again, leads to that confidence question or confidence problem that, hey, there's not a lot of new jobs out there. I'm going to stay in my current job. And if I happen to lose it, I'm not feeling real great about my prospects to get a new job. So this is a big one leading to what one of my friends calls just shelter in place with your finances right now. And so I thought that was a really good analogy that right now a lot of folks are just saying, I'm just going to wait because I don't have a lot of confidence, which goes all the way back to slide number 1 that we looked at.
Yep.
And then this one, people being worried about an upcoming recession. Nearly 2/3 of Americans think that a recession is coming, and 74% of those admit that world news and current events affect their financial decisions. So that's part of the large negative media headlines that we see. When all the news around you is bad, maybe you shouldn't do anything. Now, I disagree with that. One thing that I did a number of years ago is I stopped watching the news. I feel great, right? I'm not too worried about anything. You know why? Because I can't control it anyways, and my life is pretty darn good. But this is a real thing, particularly for real estate agents on the call. If you have clients that are worried about the economy, worried about losing their job, you want to have those tough conversations with them and say, hey, tell me, what are your concerns? Do you really want to buy a house? What are you concerned about? Maybe we need to look for a home at a lower price range. That gives you a little more flexibility. So knowing this information and that this is an overwhelming sentiment, I think we want to have those conversations one-on-one with our clients. But here's one of my favorites. 75% of economists do not expect a recession in 2026. We're actually expecting GDP to grow between 1.5% and 2% this year. And if you would have gone back and watched this presentation from a year ago, there was a lot of uncertainty around tariffs and what is that going to do. Now there's a lot more certainty around it, and we're seeing that tariffs did not put our economy all the way down. It did not ruin our GDP. Everything's kind of okay. All right. So I love these two slides in combination. Nearly 2/3 of people think a recession is coming. 3/4 of the experts think that a recession is not coming. And I think that's a big reason why Nick and I do this presentation, is to hopefully give you the real information, not just a one-line headline. Do you agree with that, Nick?
Absolutely. Absolutely.
Now let's talk about what's happening in the residential market nationwide. This is a new slide, and it's one of my favorites. So it's a little bit of a busy slide, so bear with me. On the left-hand side, this goes back to the year 2000, and the black lines are mortgage debt. The blue lines are student loans. The yellow line is auto loans. The orange line is credit card debt. The light purple line is a little tough to see, is home equity lines of credit. The green line is other debt. This might be like a buy here, pay here auto loan, or those loans that you can take out now where, hey, I'm going to finance something over 4 payments. What's that called? It's not Mint. I can't remember what it's called, but you've seen it.
Yeah. Buy now, pay later.
Buy now,
Or
pay later.
Klarna. Yep, there we go.
Affirm, yeah. So that's what that green line is. And in total, as a nation, we have $18 trillion in debt, which is a record high. But the biggest concern I see are credit cards and student loans are at all-time highs. And that makes it difficult for the average consumer to save up for a down payment. So these increasing debts, increasing payments are really stifling folks. And let's go back to consumer confidence. If I've got $10,000, $20,000, $30,000 of student loan debts and credit card debts, I might say, you know what, I'm not going to buy a house. I really need to deal with this debt first, and then I'm going to buy a house. And I think we're seeing that as we're seeing the average age of a first-time homeowner going up and up.
Yep.
Now, this one is a slide we've had before. Many renters are struggling. Factor in pessimistic consumer confidence. And as you expect, the number of people that own is declining and the number of share that rent is increasing. Now, I want to draw your attention to the left-hand slide. Look right in the middle where it says rent or mortgage. This is the percentage of people that were behind on their mortgage or behind on their rent last month. So I want you to look at the little red line. That is less than 1% of people that are behind on their mortgage. We're going to have a question here in a few minutes of, are we going to have a foreclosure boom? The answer to that right now, I'll tell you, is no. If that little red line were very, very large, that 5, 7, 10% of people were behind on their mortgage, then yes, there would be a foreclosure boom coming. But right now, this is a leading indicator. There is not a foreclosure boom looming on the horizon. However, there is 7% of people that were behind last month on their rent. That shows me that there is still some pressure on tenants that they can't quite get over the hump to buy a new property. So for us, over on the right-hand side, where you see the number of home ownership or the percentage of home ownership in the United States is declining relatively drastically. Most of you on this call own investment properties or invest in funds like Ironton that invest into rental properties. This might be a good thing for us. If there's fewer homeowners, those people have to live somewhere. What are they going to do? They're going to rent. So for those of us on the call that own investment properties, this is probably actually a good thing. Now, I want everybody to own a home that wants to own a home, but those that can't or don't want to, I want them to be my tenants. And this is a sign that owning real estate and owning rental real estate is probably pretty good right now. Now, let me pause there, Nick. What do you think about that? Do you think it's a good time to own rental properties?
I do. I mean, the average first time home buyer age is I think about 40 years old now.
That's right.
And if you're in expensive markets, maybe in more affordable markets, it's a little bit lower than that, like mid to late 30s. But I mean, when you look at the residential market, the step-up homes, those aren't doing as bad. It's the first-time home buyer side of things that's really causing this decline in buyer activity. A lot of the new product being released into the market, they're just, even at a first-time home buyer, they're largely unaffordable at the interest rate environment that we're at now. And they have been for the last, 3-4 years at this point in time.
That's right.
So, yeah, I mean, as that, I don't see that reversing anytime soon. Mortgage rates need to come down substantially, or incomes need to go up, at a much higher rate. So I do believe that, yeah, if you've got a bunch of cash, you've got a great job, you've got liquidity, and you're in a position to own investment real estate, I think it's a good move. I think you've got a lot of leverage as a buyer, but also I think that you're going to have a tenant pool for a lot longer, considering when people are really, they're pushing off starting families, they're pushing off their first time home purchase. So I think that's, in favor of us as rental property owners.
Yeah, I completely agree. And then this is exactly what you were just alluding to. The average age of a buyer and the average age of first-time buyers is going up, as saving up for that down payment is much more difficult. So I want to bring your attention to the light blue line at the very bottom. The average age of a first-time buyer is nearing, 37, almost 38 years old. If we go back to the early 1980s, the average age of a first-time buyer was like 29. So we've added an entire decade that it takes for folks to save up for a down payment. Now, what I'm seeing is my buyers that are younger, that are in their 20s, maybe in their early 30s, they're often still buying homes, but guess what? They probably need parental help. They might need a help for a cosigner or a help of a gift of down payment. But if you're just an individual, particularly if you're a single individual, it can be more difficult to buy a home right now because prices are up, taxes are up, insurance is up, HOAs are up, rates are up. It's just harder than it has been in the past. And that is stifling some activity. And again, all the way back to slide number 1, if it's harder to buy a home, harder to be more stable, that leads you to feel less confident about the economy moving forward. Student loans, these are actually experiencing a lot of distress. So student loans are the line that's in light purple. And you see now student loan delinquency is greater than 15%. And that is the highest we've seen, I think, ever. We had a really long period of forbearance through the pandemic and afterwards that folks did not have to make payments on their student loans. And ideally, what you should have done is saved that payment, put it in the bank, let it accumulate interest. Then once you have to start making those payments again, you've been saving up for those. Unfortunately, what we saw is a lot of people spent that money. And now you've got to make payments on student loans and they're having trouble keeping up with it. So that really impacts first-time buyers as well. The next slide here, because there's less buyers, we are seeing families stay in their homes longer than ever, right? So the home sales per 1,000 homes in the first 9 months of the year peaked in 2021 of 44 homes for every 1,000. Now that's down to 27 homes for every 1,000. So let me phrase this as a question. Real estate agents on the call, over the last year to 2 years to 3 years, did it just feel like there was less activity? Did it just feel like there weren't as many people doing things? You weren't having as many conversations. It just felt like there was not as much activity as there had been in the past. If you're an agent and you felt that way, put yes in the chat, because I'm really curious always about our audience. Did you guys feel that over the last couple of years, that it just didn't feel like as much was happening? Alex says yes. Nick, I'll poll you. What do you think? Has it felt like things were slow?
Yeah, absolutely. And I'm in the multifamily world. And so there's a lot of, of course there's a lot of distress there, but there's also limited activity there as well, right? Interest rates have made things a lot more difficult. A lot of people have been locked into, maybe they went through the refinance frenzy, or they bought a house in 2020, 2021, early part of 2022. And it's hard, to go from the house you're in that has a 2.8 mortgage rate to, if you were to buy that exact same house, your payment would be about $1,000 higher, maybe even more, with that same down payment at today's interest rates. And so, unfortunately, we've been spoiled. We're never going to see those interest rates again. I hope we don't, because that would not be good for the economy, as much as people would probably like to get that. But Yeah, I think that's a huge driver of it. People have insanely low interest rates. Why would I go buy a house at a 6.5% interest rate unless I have a significant lifestyle change that requires me to do so?
That's right. So if you take that 44 homes peak in 2021, 44 homes out of every 1,000 turned over, and now 27 homes out of every 1,000 turnover, that's a big decline. And that's why it just feels like there's not as much happening, because guess what, guys? There isn't. There's just not as many transactions going on in the market. And so if you're a real estate agent, you need to be really on your game to capture your share of that market, because it's a shrinking pie right now. Now, I do think it's going to increase a little bit in 2026. And I think we're going to see the number of transactions increase in 27. But right now, the pie and the number of deals that are going on is less than it's been ever since back to 2012 on this chart. But I do happen to know the activity for last year was the lowest since 1993. So think about that, guys. The lowest number of transactions, 2025, the last time we had that low was in 1993. That's 32 years before. So the market is drastically different. And that's why you might be thinking, boy, it just feels like there's not as much going on, because there's not.
And that's why if you're a buyer here and you've got a lot of cash to deploy, it's a great time to buy, because sellers, they've been sitting on their property for who knows how long, right? Maybe 30, 60, 90 days longer than they thought. They've made a number of price adjustments. It's a great opportunity. You've got a lot of leverage as a buyer to come in, get what you want, offer what you want, and have a good chance of getting that. So, if you're a lot more confident than what the prior chart suggested, and you've got a bunch of cash and you need to deploy, I do believe, and I know, Joe, you'll probably back me up, but I do believe right now is a fantastic time due to the limited activity, the lack of confidence, the lack of certainty, and the leverage ultimately, meaning the position of power that you're in as a buyer right now to get what you want on various deals.
100%. I would agree with that.
Yeah.
But here's the thing, guys. There is light at the end of the tunnel. All right. So the impact of the lock-in effect is easing. All right. The share of mortgages that are under 4% has dropped from greater than 73% of the market to less than 50% in the last 3 years. All right. And the share of mortgages over 6% grew from 5% to 23% in the first period, or in that same period. Now, I want to draw your attention to the dark black line that's right in the middle. So in 2020, very few people had a mortgage interest rate below 3%. And then what happens? Interest rates are very low. A ton of people refinance or buy at rates of 1%, 2%, 3%. And then it peaks in early 2022 that there was more people with an interest rate below 3% than at any time in history. And Nick, there was one sentence that I heard a lot of people say at that time. Do you remember that sentence? I'm going to put you on the spot. Do you remember what people said?
I'm going to fail. I can't recall. What was it?
The sentence was, I have a 2% rate. I'm never moving. I'm never selling my house because I have a 2% rate. And at the time we were doing these presentations and I said, that's true right up until it's not true. And what did I mean by that? Life goes on. You have a 2% rate. You might say, I'm never selling this house. You get divorced. You get married. You have an illness. You have a child. The house no longer meets your needs. You get relocated for work. You have to move for some reason or another. You sell that home. And guess what? That black line is declining because life goes on. And some of those folks that had those ultra low interest rates have had to sell, have had to refinance, have whatever. And you're seeing that lock-in effect is gradually easing. It's now down to only 22% of homeowners have a rate below 3%. So that frees up exactly what Nick was talking about earlier. All right, I've had to sell this home that had a 3% rate. I've bought a new home at a rate of 6.5%. You know what? Now we're going to have another baby. It's not that big of a deal to trade up again because we need more space. So we are seeing that lock-in effect really begin to ease. And I think that has helped bring more listings back to the market. Would you agree with that, Nick?
Yeah, and we're going to obviously continue to see this trend decline, unless we magically somehow get to, 2-3% mortgage rates again, which, like I mentioned before, I don't ever see happening. So,
No.
yeah, we're going to continue to see that. I think they'll normalize. I think at this point in time, I mean, you're talking directly with buyers, Joe. I got to imagine, like you said, people's lifestyles are changing, and the mortgage rate. It was maybe a little shocking in 2022 and three when we went from 2.5%, 3% all the way up to 6.5%, 7% in such a short time.
Yep.
But we've been pretty stable around that mark now for several years. In fact, we're seeing it trickle down a little bit, right? So I think people are getting used to it. And to your point, the 3% it's very attractive, but if you're having kids and your lifestyle changes, you want to move to a nicer area, you're going to do it.
That's
You're not
right.
going to say, my 3%. We're going to keep the 3% in my 1,000 square foot house. Actually, I need a 2,000 square foot house. I'm going to go buy another house. That's it.
That's right.
So, we're going to continue to see that trend go down, obviously, as more and more activity picks up. So we'll see less and less people under a 4% mortgage rate over the next several years.
Yeah, absolutely. So that is some light at the end of the tunnel, guys. Like I mentioned, I think activity in 26 is still going to be pretty low historically, but I think in 27, we're going to start to see some of that pick up. So for real estate agents on the call your database, check in with your people. Just because the market as a whole is a little bit down doesn't mean that you have to be down. You absolutely can and should outwork the market. So if you ever need a business plan session on that, call me. We'll do that separately offline. But that's something I think right now is a great opportunity to outwork the market. All right. The number of homes with market rate mortgages increase. We expect more people to tap into that equity. It's exactly what we were just talking about. And existing home sales. So this slide's a little busy. We want to look down at the very bottom. There's a green, a blue, and a brown line. That is the post-COVID bust, if you will. And I want to draw your attention to the orange and blue line right in the middle. 2015 to 2019, those were the pre-COVID normal years. And if you compare where we're at now to where we were at back then prior to COVID, we're still down and transacting about 1 million homes less on an annual basis nationwide. That again goes back to it just feels like there's less activity. It's because there is, guys. But again, you can personally outwork that and outrun it just by calling your database.
Yep.
New listings, we are seeing this over on the far left-hand side. This is very similar to what we saw in 2025 as we start the first month of 2026. And so I think we're going to see new listings continue to increase and be up slightly compared to 2025. But I don't think we're going to hit the low number of listings that we had in 23, 24, and certainly not during the COVID years. And total inventory is likely to increase. And this goes back to what Nick said earlier. We've got some great opportunities if you're an investor or maybe you want to buy a primary residence. Find properties that have been on the market for 90, 120 days. You can ask for a lot. You can ask for price reductions, seller concessions, repairs. You can get a lot done when sellers are a little more desperate right now than they have been, especially in recent years. And this goes along with that. We are seeing the median days on market increasing. Current median days nationwide is 78 days. So Nick, you've sold a home and you've worked with sellers in the past. If I remember that I could sell my home during the COVID years and I could sell it in the first weekend, and now I can't sell it and I've had it listed for 30 days, 45 days, maybe 60, maybe even 90 days. How's that conversation going with my listing agent? Am I friendly and just saying, oh, no big deal? Or am I maybe a little more tense right now?
I'm a little tense. I mean, and you look at people are saddled with debt, right? I mean, so there's credit card debt, there's HELOC debt, student loan debt. So if you're somebody that's saddled with debt, right, and your house has been sitting on the market for 90 days, you're having a tough conversation with your real estate agent, or you're having to make some drastic changes on your pricing because you need to get out of a situation. So,
yep.
Yeah, I mean, it's definitely not a friendly conversation. I'll say that.
And so if you're a buyer, this is your opportunity. Look for properties that are greater than that median listing time frame, because right now that seller is frustrated, the agent is frustrated, and they will be open to having a conversation and making a deal. So if you're buying investments, or for your primary residence, look for aged properties, because everybody that's on the other side of the transaction right now, they hate each other. And this is a great opportunity for you to come in and get some really good deals.
My neighbor has had 3 different brokerage signs in front of their yard, guys. So if you're looking for a house near Sloan's Lake, I think they're pretty desperate at this point in time. Okay. So
Yeah,
when you got the 3 brokerages, it's maybe, it might not be the brokerage, might be something else. It's the market telling you what needs to be done.
I'm not a real estate expert. That house might be overpriced.
Yeah, just a little bit.
List price, we are seeing these flatten out a little bit, have been pretty flat since last January, and list prices are down roughly 2.5% since 2024. Now, you might be sitting there and think, oh my gosh, that means values are going down. Maybe, maybe not. I think we've seen pretty flat appreciation. I think condo prices have been down, but just because list prices are down does not mean that the value of your home has gone down. It just means that properties are not listing for as high as they once did, but that could be an impact of fewer higher price listings and more lower price listings. So that can be a tricky one to really understand, but we are really seeing prices sort of flatten out, I think. I don't think we're going to see any major crashes. If you have some condos, you've probably already experienced some price declines, but that's not the end of the world. But here we are seeing price reductions. And I love how this falls off a cliff late in the year. If you look far over to the right, you see a ton of price reductions in October, November, and December. That is a very seasonal trend. Prices are usually flat to up through the spring, or beginning of the year through the spring, flatten out through the middle of the year, and then go down for price reductions as people are desperate to sell their homes through the holidays. So nothing surprising on this chart. We want to talk just a little bit about real estate downturns and how it works. Every downturn ends in a recovery. And go back to the 1980s recession, the 2008 great financial crisis. You might see prices fall off a cliff. What happens at some point? You reach a point where it's now a good deal, and these prices start to go back up. If you look at our downturn we have on the far right, 2022, interest rates really increased in 2022, and that has slowed demand. But I think we're at a point that we're going to begin to slowly dig our way out and slowly begin to recover. Do you agree with that, Nick?
Yeah, I mean, look, everything goes through cycles, right? It's easy to sit in a bull market, or in times of mania and think that this is going to last forever, right? Or you sit in a bear market or in times of, decline and think that this is going to last forever. But the good news is, if you look at history, that's never the case, right? I mean, maybe some recessions or some downturns last longer than others, but for the most part, if you're willing to be patient, you're going to get through that cycle and you're going to go right into the next cycle. So we're in a downturn, both in limited buyer activity and the commercial side. We're seeing property, valuation, a lot of downward pressure on property valuations, but we're at the bottom of a cycle. And, we've all been told in every book that we've read that you invest at the bottom of the cycle, and that's where you make your money. And so, there's going to be a recovery. I don't have the magic 8 ball to say when, but there's going to be one at some point. We just got to look at the economics of today and make our, investing decisions based on what's historically happened, I think.
100% agree with you.
Yeah.
And I love this slide. This is not the first time the market has slowed down, and sales always come back. So if, again, these 4 highlighted slowdowns on this chart are the same 4 highlighted slowdowns on this chart. And you see 2022 to current, the number of home sales have gone down by roughly 39% as compared to the peak before that. But the home price trend has been pretty flat. However, mortgage rates have been up. As mortgage rates come down, which they currently are, you're going to begin to see that recovery. So I think this is actually a pretty long downturn, actually. 2022, it was it? I think it was March. I think it was March 15th of 2022 when interest rates crossed 4% on the upswing. So we're going on 4 years that rates have been higher than they had been in the prior 4 years. So this has been a pretty long downturn. I think we still have a ways to go, but there is a recovery that's getting closer, which we spoke about earlier, with the lock-in effect beginning to ease. Now, our price is going to drop. Nick, let's take a poll. Put in the chat, yes, you think prices are going to drop, or no, you think prices are not going to drop. So yes, prices are going to go down. No, prices are not going to go down. What do you guys think? Would love to take a quick little poll
Yes.
here.
We got some yeses coming in early.
What do you think,
Yes,
Nick?
drop. I think they will. I think they will. I think that affordability is going to continue to remain a huge challenge.
Yep.
And if you're a seller that's been sitting on your house for 4 or 5 months, I think you have no choice but to drop your price if you want to sell it. So I do think prices will drop. Yep.
I agree. I love what Robert said. He's right down the middle of the road, flat. I think that's true. Forrest, if rates go to 5%, prices are going to go back up. Spot on with that, because if rates go to 5%, every buyer on the planet will get off the fence, and we'll start having bidding wars again. I love the mix here. Some folks think yes, some folks say no, some folks say flat. I love this. So thank you guys for participating in our little poll. What we see here is population growth has slowed down. Population growth is one thing that leads to just natural appreciation of properties. As you have more buyers chasing fewer properties, that drives prices up. We've seen population growth slow down for a number of reasons. Price cuts are bigger in a slower market, right? And this is what we spoke about earlier, that if you've got a property that's been on the market for less than 7 days, you're probably not lowering that price. But you've got something that's been out there for 6 months, 8 months, a year, you are probably lowering the price to try and get that property sold. And then home affordability. This is a big one, guys. Home affordability was really stifled. If you look on the left side of this chart, in 19, 20, and 21, home price growth far exceeded wage growth. All right. So if I make this much money and home prices are going up like this, I can keep up with it for a little while interest rates are really down, right? But my income goes up a little bit, home prices go up even further. Before long, home prices are way out of whack with how much money I make. Mm-hmm. And this is exactly what we saw in 19, 20, and 21. But now that trend is reversed. We're seeing incomes grow faster than homes. So we are trying to get back to balance, but we do have a ways to go. I love this chart. I got to send Lon a special thank you note for putting this one in here. Ideally, we want to see for the next year, 2, 3 years, the blue bar, wage growth, being larger than the orange bar. That's going to help bring us back into balance. And we have experienced that in the last 2 years, a lot in 22 and 23. So this is a big factor for all of us on the call. We need wages to continue to try and keep up with home prices. Until these are back in balance, you're going to see stifled appreciation. But please go, Nick. What were you going to say?
No. This is probably one of my favorite charts that I've seen so far. We were just talking a little bit ago that, right, for things to become more affordable, we need to see interest rates come down, or if they remain stagnant, we need to see wage growth outpace home price growth. And in 2025, it's the first year we saw that. So if we continue to see that trend, that'll bode very well for first-time home buyers, really all buyers in general. So this is the kind of, balance that we need to strike. 2020, 2021, 2019. I mean, it's so obvious how challenging of an environment that was. But it's good to see that that's the balance is in favor of the wage growth heading into 2026.
Yeah, I completely agree.
Yeah.
Prices are forecasted to increase roughly 1.6% over the next year. Now, NAR is the most optimistic, and I love Lon's quote here, as usual. And the MBA, that's the Mortgage Bankers Association, they're the most pessimistic, right? So NAR, they're always focused on home prices are going to go up, do transactions, call your database. Everybody, the Mortgage Bankers Association is like, oh, mortgage rates are 6%. The world is ending. We're all going to die, right? Well, I think the reality is somewhere in between those two. And I really like the average of 1.6%. I actually really like the Fannie Mae economists that are at 1.3. I follow a lot of stuff from Fannie Mae and Freddie Mac, and I really like their projections for this year. I think we're going to be right in the middle. I think NAR is too optimistic. Yeah. I think the Mortgage Bankers Association is too pessimistic. I would love to know what you guys think. Well, I guess we talked about that. We already had you guys put in a quote, which kind of lines up, right? We had some people some people were on the NAR side, that home prices are going to go up. Some people were on the Mortgage Bankers Association. and some people were right down the middle. I'm kind of the right down the middle, flat, maybe 1%. I don't think we're going to see a big swing in either direction. Now, this is what we were talking about earlier. This one, and I love Lon's quote here, we're skeptical and suspect it will be lower. Home sales volume is projected to increase 9% in 2026. I completely disagree with that. The last 2 years, we have closed just over 4 million transactions as a nation. I think 2026 is going to be almost exactly the same. And for those of you here in Denver, Denver was the lowest number of closed transactions in January. The January that we just had in 2026 was the lowest number of closed transactions that we've had in 15 years, 16 years.
Wow.
So we're starting out very, very low. We're going to have a huge spring selling season to hit this projection of 4.5 million. I think that is too optimistic. And this is a slide from NAR. Again, love the guys over there. Lawrence Yun, who does their chief economist, love what he does, but I think they're too optimistic on this. What do you think, Nick?
Yeah, and this goes into always know the source of the forecast. Okay. Forecasts are marketing at the end of the day. So like you said, Joe, NAR they want people to be active. They want people to be buying homes. So of course they're going to be more aggressive. I like leaning right in the middle. I think the extremes, it's best to ignore the extremes. There's usually some bias towards those arguments when you're in the middle somewhere. I think that you might set yourself up for some better expectations. So yeah, I agree. I think sales volume will be down. Again, I'm very much in the camp of affordability as a huge challenge. I've been fortunate enough to buy 2 houses, but a lot of my friends have not. And so I see the struggles that they have saving up for down payments. So I think that will be a major headwind for a long time here.
I completely agree.
Yeah.
Debt to income ratio, we've covered this in the past. Buying a home is taking less of your income. So I do love this chart. Really, the affordability level is you want to see that your home expenses are 30% of your income or less, which is that red line. We saw in the early 2000s, the 2010s up to 2020, homes were very affordable compared to wages. A big factor of that was low interest rates through the COVID years. January of 22, you see interest rates begin to go up, and then homes became less affordable, really peaking in late 2023 when interest rates were nearly 8%. Since that time, interest rates have come down. We're going to talk about that. We're very close to 6% right now. That has helped affordability, but we really need wage growth to continue. That sort of naturally brings this orange line back closer to that red 30% affordability line. So this is something we're keeping a very close eye on. But I really agree with Lon's comment here. Buying conditions have improved a lot over the last 2 years, and I completely agree with that. Now, will there be a foreclosure boom? We've touched on this. No, not a chance. There is way too much equity, way too many people that are not behind on their loans, which is good. So is there going to be a foreclosure boom? Absolutely not. We talked about the leading indicators earlier of delinquencies. We do not see enough delinquencies. There's less than 1% of mortgages that are behind right now. So very, very small delinquency. And you have to fall behind on your mortgage before you go to foreclosure. With less than 1% of people behind, very, very low foreclosure coming up.
Mm-hmm.
Are mortgage rates going to go up or down? You know what? They're already down. I think we've got a slide here. Yeah, this one I love. If you would have bought a home 9 months ago, the median monthly mortgage payment was $2,882. If you bought a home today, that payment has improved by $400 down to $2,413. So mortgage rates have been trending down. If you bought a home a year ago, 2 years ago, 3 years ago, please give me a call because you likely have opportunities to improve your 30-year fixed rate and get a lower monthly payment right now. Now, I do see one point here. Oh, Robert, I love this. A higher percentage of homes are subject to additional property taxes, such as metro districts, and big increases in insurance rates. We don't have the slide in here tonight, but the monthly escrow portion of a principal and interest payment, principal, interest, tax, and insurance payment, the monthly escrow portion is now approaching 40% of the total monthly payment on average. So think about that. In the past, your escrow payment was less than 20% of your payment, but now interest rates are up, taxes are up, insurance is up, and escrows are making up a larger and larger portion of that PITI payment, which is making affordability a big challenge. So Robert, you're spot on with that. Unfortunately, I only control interest rates. I can't do anything about taxes and insurance. But if Lon were here, I would tell him, hey man, I've been lowering rates for you. I'm doing a great job, aren't I? All right. Let's move along here and talk about what's going to happen in the future with mortgage rates. I am right here with the red line, Wells Fargo. This is one where I disagree with my good friends over at Fannie Mae. They think that rates are going to end the year closer to 5.9%. I think that is optimistic. The Mortgage Bankers Association, they think everybody's going out of business. They're the green line. They think rates are going to end at 6.4%. I really like the Wells Fargo predictions that rates are going to remain mostly flat this year. So if you have customers or buyers that are saying, hey, I want to wait for rates to go down, that may not happen. I would certainly share this chart with them. Now, this is just a prediction, but rates have already come down. And there's not a lot of economic things on the horizon that are going to push rates lower or any further down. But there might be surprise events that could push rates up. So if you have buyers on the fence, I would absolutely share this with them that right now might be a really good opportunity. And we are still very attractive compared to historical. So we're just above 6% on an average for 30-year fixed right now, which is really, really great. We are seeing activity increase, kind of a couple of busy charts here, but you are seeing on the left-hand side mortgage applications. That's that large dark blue line. We are seeing applications increase in the first few weeks. Been a little slower this week and last, but overall activity is beginning to trend upwards as compared to prior years. How do mortgage rate changes impact the market? Pretty easy. As rates go down, more people get off the fence and more people buy. We are getting really close to the end. Rentals, vacancy. Nick, this is one we've seen has really kind of increased over the last 6, 8, 12 months. Vacancy rate is now upwards of 6%. How is that impacting your analysis when you're looking at rental properties?
Yeah. So, I mean, the traditional, underwriting that I think the assumption that most people have went with from a vacancy standpoint is that 5%. You typically, whether you're underwriting a small multifamily, large multifamily, single family rental, you might assume a vacancy of 5%. But I think if you're underwriting and you're looking at buying an investment property, I would stress test your underwriting beyond a 5% vacancy.
Completely.
Right here, we're seeing 6, right? In some markets in multifamily, we're down into the 80s from a vacancy standpoint, from an occupancy standpoint. So I would stress test and see how low you can go from an assumption standpoint. Be ultra conservative. Don't be like NAR and estimate that you're going to appreciate at 5% a year. Think conservative and stress test your analysis across multiple assumption categories. The assumptions we used even a year ago or 2, 3 years ago are not the same assumptions we need to be using today and in the next couple of years. Yeah.
And one thing I would add to that, not only is vacancy increasing, but lease out times are increasing. I'll give you a quick anecdotal story. I have a property that we had an eviction in September. We had to do a unit turn on it, which took about a month. We listed that property for rent October 15th. It's a 3-bedroom condo. Prior rent was $21.95. Now, of course, they didn't pay it, so I had to evict them. They paid it for a little while. 3-bedroom condo in Denver proper was listed for rent at $21.95. That was October 15th. It's now February 17th. So it's been listed on the market. What's that? Almost 5 months. We've got it down to $17.50.
Wow.
You're just now getting traction. We had 10 showings last week. And we got 1 application that did not qualify. But at $21.95, no showings. $2,100, no showings. $1,900, no showings. We had to get it down to $17.50 to generate interest. So if you're experiencing vacancy, if you keep the rent the same, your lease out time might be much longer than traditionally we have seen, especially in the Denver market. Now, that's just one property, but I do have a very large sample set from my property manager that they're seeing that across the board in A units, B units, and C class properties. It's taking longer to rent them, and they're not renting for what you would have thought a year ago or 2 years ago. So if you have rental properties, make sure you're doing a really thorough analysis on what to rent those for, because that long lease out time can really kill your profits.
Yeah. In addition, I'm glad you brought that up, Joe. I think the name of the game right now is occupancy. And if you have to concede on your rent a little bit, even on a renewal, I mean, if you have a tenant that you are renewing and you're sensing that they might want to leave, they might be able to go somewhere else and find something cheaper. So if you need to maybe even concede $100 on your rent to keep that tenant in there, you're probably it's probably in your best interest to do that. Turnover costs are elevated. Joe, we had to evict a tenant, in one of our properties in Northwest Arkansas, and guess how much it cost to turn the unit over?
Oh, 25 grand.
No, not that much. 2,100. I guess maybe
okay.
2,100 isn't so bad.
Dude, I'm moving to Arkansas if a turn is only $2,100.
Yeah, but it's still, if you think that you're going to spend less and then it ends up being that, it's a lot, right? I mean, it wasn't a complete demo type of situation, but it's just a lot of the tenants, their delinquency rates are up. They're suffering. I mean, these are tenants that they're paycheck to paycheck. So
that's right.
The modest bump, or if they're, blindsided by an auto, bill that they didn't foresee coming in, that puts a lot of downward pressure on their monthly cash flow. So anyway, point being, I think the game right now is occupancy. And if you can renew your tenants, even if you have to concede a little bit in rent, it's probably better off doing that. Otherwise, you're going to have to turn the unit over and you might suffer 2-3 months of vacancy, which is the loss of that is far more substantial than coming a little bit down on rent just to get that renewal in place.
Yeah, I completely agree with you. Well, as we're wrapping up here, guys, I put my contact information in the chat. Nick, I'm sure you'll do the same.
Yeah.
Would love to hear any final questions that you guys have. We are right at the end of our presentation, so I'm really impressed with us, Nick. We got through all of the slides. Robert has a great question here. Has Colorado become somewhat less landlord friendly with new laws more friendly towards tenant? I would say 100% yes, and I would actually remove the word somewhat. Colorado has become less landlord friendly and much more friendly towards tenants. Evictions are more difficult. Habitability is more difficult. Single unit property inspections, especially if you're in the Denver market, are more difficult. Be prepared. It is harder to evict tenants. It is harder just in general to be a landlord right now. I think we've got an upcoming webinar with Eric Ross from CRT Management. If you are self-managing, I would highly encourage you to attend that webinar because Eric and his team do a fantastic job of mitigating your liability around evictions, habitability. And if you don't know the laws, you can get into a lot of trouble when you're trying to evict somebody if you have not followed all of the exact correct steps. Robert, such a good question. Colorado is not landlord friendly currently. What do you think, Nick?
Yeah, I think there's a lot of legislative risk here as an investor in Denver, among the many other headwinds that we're facing, even just from an affordability, and interest rate standpoint. So, Robert, if you don't want to wait till that webinar, you can reach out to me to nick@irontoncapital.com, and I can send you the replay of the last webinar that we did. We go through all the changes that have happened in Denver in the last 2 years.
Yeah. Any other final questions? We have 3 more minutes. So put anything you want to know in there. Nick and I will do our best to answer that. And thank you guys for joining us. This has been great. I love all the new slides. So again, we got to send a special thank you note to Lon. He puts a lot of time and energy into this and really helps Nick and I look smart because he does all the homework for it.
Yep. Well, he's off. I think he's in Italy now, or he was somewhere in Europe. So still putting all these slides together. Robert, is percentage of homes purchased by institutions dropping or staying about the same?
I think that is dropping. I don't see any large hedge funds purchasing properties right now. All of the investment transactions that I see are what I would call mom and pop investors, guys like me, guys like Nick, folks that own less than 10, 20 number of homes. I do think that in institutions it hasn't stopped, but I think it's gone down significantly. What do you see, Nick?
Yeah, I think that is it's a huge headline we see a lot in the news, but I think that the reality when we really drill it down is that institutions own a very small percentage of the single family rental market out there. They're more buying the 300 unit apartment complexes. There's much greater economies of scale. They're not really interested in buying 300 individual houses scattered across a geography or
That's right.
multiple geographies. It just doesn't make a lot of sense to them, right? So, I think it is dropping a little bit, but I think at the end of the day, it's the media and the news makes that seem to be a much larger problem contributing to the unaffordability in the market that I don't believe is necessarily true. I think they only own about 2% of the single family rental market. So it's a very small percentage of the overall pool.
Yeah, I think that was a big headline 2 or 3 weeks ago of, hey, we're gonna ban institutions from buying single family homes. The institutions already banned themselves because they stopped 3 or 4 years ago. I think that was very much of an attention grabbing headline, but it's kind of already happened. So
yeah, guys, I've spoken with a lot of investors who, if they're interested or they want to do an analysis on selling a rental property, we do those analyses with investors. I do several of them a week. You can go to irontoncapital.com YC if you're considering selling a rental property and maybe you want to allocate it with us or do a 1031 or put it into a DST. We'll run all those scenarios for you, compare them against each other, so you can see the numbers and make a decision with the business case that's presented in front of you. So feel free to go to this link. I'm happy to discuss with you guys if you're in that boat.
Okay. Nick, thank you so much, man. Always appreciate it.
Thank you, Joe. Appreciate you guys being here, and we'll see you next month.
Thank you, guys.